Good morning, everyone. My name is Brenna Aguilar, and I work at Montecito Trust. I manage all of our community programs, and one of them is our education program. So we go out and teach various seminars ranging from home buyer, financial literacy, cybersecurity. So if you ever do want other presentations, we do all these in the community for free. Anywhere from, say, we can do K to grade, we do kindergarten to seniors. So please let us know if you ever do want a presentation. But today I'm here to talk about preparing to buy a home. I know in our market, this is something that feels very overwhelming. There is not a lot of inventory, especially inventory that's affordable, but there are resources out there. And I know there's going to be people today talking about some of those resources, and I'll touch on some of them as well. But just today we'll be talking about things that you can do to help you to get to that point to be ready to buy a home. This is just our disclaimer that things change over time, and so everything is up to date as of today, but just be aware that things do change over time. And this is only for educational purposes, and there's lots of laws and regulations associated with mortgage, so please make sure that you are informed and ask lots of questions to your loan person, your realtor, as you're going through the process, because they need to help keep you informed as well. So today we'll be talking about budgeting and saving, your credit score and the pre-approval process, and qualifying for a loan. So there's lots of different costs associated with buying a home. You know, the biggest one is your mortgage, but also to be aware there's the property taxes, and then different types of insurance. There's your general home insurance. Depending where your home is located, you may be required to have flood insurance. Earthquake insurance is also available. It is something that is optional. And then PMI. PMI is private mortgage insurance, and that has to do if you are not putting 20% down on a home, then you're required to have PMI to cover the difference between what you put down and the 20%. And then once you get where you own 20% of the home, that insurance will fall off. So budgeting is something that can really help you to understand, one, what you need to do as far as if you're trying to save, how you can start making that a part of your plan to save for a down payment, but also helping you understand really what can I afford? What is my monthly income and my expenses, and what can I really be able to afford? And a budget, also for those of you who have children, is just a really good way to start getting them prepared for when they're going to be living on their own. Of course, you may not want to share your entire budget with them, but just getting them in the habit of making a budget is a really good tool that you can share with them. Making a budget is pretty easy, and lots of people make the budget, but then the biggest step is they don't always follow it and check up on how they're doing. But as far as if you're going to be making a budget, the first thing you're going to do is you're going to track your daily spending. Understand really what you're spending month to month. You're going to determine what your income is, your various expenses, and then through that process, you can start to identify where are my opportunities to decrease my spending and where are there opportunities to increase income. It is often much easier to find opportunities to decrease our spending than increase our income, because I want to make more money doesn't mean it's always possible. My boss isn't going to give me a raise just because I asked for one necessarily. And so it can be more challenging. We're a little bit more limited on income. This is a tool that's actually available on our website. Montecito.bank is our website, and we have different resources under our financial literacy section. But this is a daily spending tracker. So just like students have to track their homework assignments, or people may track their food and their calorie intake and their exercise, this is something that a tool that you can use to track your spending. And one of the things is, like, I can say, oh, this is how much I think I spend, but when I write it down, it's more of a reality of what I actually spend. And you'll notice at the top, there's different categories. These are kind of the main categories that your spending will fall into. So your housing, your transportation, your utilities, your food, You'll see savings is up there. We try and think of that as a bill that we pay to ourselves, and how am I making that an active part of my budget. Personal items or expenses, and then we have an other column. But this way, anytime you spend money, you can track this. Another option is you can go through your credit card and your bank statements and start to identify those things and put them in these categories. But we have you do this for a week, and then use this tool, which is the monthly budgeting tool, and you're gonna plug those totals in each week. At the top is where you're gonna estimate what you think you spend month to month on these different categories. And at the end of the month, you'll total up what you actually spent, and you'll see what's the difference. What did I think I was gonna spend, and what did I actually spend? And what's that difference? Did I overestimate or underestimate how much I spend, and I'm just overspending because I need to control how much I'm doing different things? Or did I underestimate how much something actually costs? There are certain things that we have control over, like how much I'm spending on food to a certain extent, right? If I'm eating out, it's a lot more expensive than if I'm cooking at home. But there's things that are outside of our control. As I know, I have a 14-year-old and a 12-year-old boy, and they eat an insane amount of food, and the cost of food is rising. And so not only are they eating more, it's costing more to feed them. And so my food budget is going up. And I can't necessarily control that, except for, okay, we're gonna eat out less, and try to eat at home more. So some of those things are outside of my control, just like transportation. When the cost of gas goes up, I may still be driving the same amount, but it's costing me more because the cost of gas is going up. The other thing when I'm making a budget that I think about is there's certain months where I know I'm gonna have more expenses than others. So it's starting to get cold now, and so I know at some point I'm gonna let my kids turn on the heater in the house, and my gas bill is gonna be more than it is the rest of the year. So I know that from like December to February, I need to budget more for my gas bill during those months because I'm spending more because I'm actually turning on the heater. Versus the rest of the year, my gas bill is relatively low. So those are adjustments that I need to make and plan for. And maybe it's putting more savings aside so that I can manage those costs, or it's decreasing costs in other areas. But this is just a really good tool to help you. There's also different, apps that exist within banking apps or standalone apps where you can link your credit cards and your bank statements, and it can help you analyze your spending as well. So those are really good things that are helpful. So your down payment, this is oftentimes the biggest barrier to being able to buy a home. It's not necessarily that the mortgage is going to be more than your rent. Oftentimes your mortgage ends up being less than what your rent is, but it's how do I get to that down payment? And so a down payment will really depend on the type of loan that you're going to get. A traditional loan will require a 20% down payment. FHA loans, which are first-time homebuyer loans, will require as little as 3.5% down. VA loans, so these are people for our veterans who have served. There's VA loans, and they may not require any down payment. As I mentioned, if you put less than 20% down, most lenders will require PMI. So you do have to have private mortgage insurance. But FHA loans, again, often you can get as little as 3.5%. There's different types of loans that you can have where you can have less than 20%. There's also down payment assistance programs that can help you with that. I believe at 12:30, I think it is, there will be one on that. There's also some down payment assistance programs that I'll talk about a little bit later. Or right now. So your savings of a down payment can be, your sources can be from different things. It can be your savings. You can have a gift. So if there's a family member or somebody who's helping you to buy your home, that can be part of your down payment. Your 401k actually can be a source of a down payment. You want to be really careful if you're going to do that. But you can borrow from your 401k and then you will eventually pay it back. But that is something that you can do that you aren't going to get processed. Question any item you don't recognize. If somebody is not willing to answer, your question, then they should not be somebody you want to work with. Because you're going to be working with title companies, you're going to be working with realtors, you're going to be working with your lender. So you want to understand everything that you're doing. If you're not sure, don't sign. There's a lot of great resources out there. The Coastal Housing Partnership, if your work is a member of theirs, they have a lot of great workshops that are more in depth. And they have some resources available on their website that you can look at. There's different people that you can talk to, but make sure the pre-approval letter, most realtors, when they do that, when you have a pre-approval letter, your offer is going to be taken more seriously because they know you've been approved for this loan and you're ready to go. Like if your offer gets accepted, you already have everything into the bank and they have said, we're going to pre-approve you up to this amount for a loan. And so, you know, this is how much that I have to be able, and the realtor is like, okay, this person is serious. And it's not going to be something that falls through. To get pre-approved, the documents that you often will need is your W-2s for your past 2 years, 2 years of tax returns, your bank statement for the last 2 months, most recent year-to-date pay stub. If you're self-employed, a year-to-date profit and loss statement. But this is all information, and anybody whose name is going to be on the loan is also going to have this. So if you're buying it by yourself, you're good. You just know what you need to have. But if you're buying it with, your partner or somebody else, you're going to need all of this for everybody whose name is going to be on the loan. So lenders are going to look at your credit history, your monthly pre-tax income, your monthly expenses, and your down payment. Because they have to determine your debt to income ratio, because we're only allowed to offer loans based on so much of what your debt to income ratio is. And that's looking at what your monthly payments are. So they're going to estimate, what your housing cost is going to be. If you have a car payment, if you have any credit card debts, any other expenses that you have, and they're going to look at your gross monthly income, and that determines your debt to income ratio. So things that can help when you're in the home buying process. Be aware of all issues that are associated with the property that you're purchasing. Sometimes, there's maybe issues that you're aware of and you're willing to take those on because the property is coming at a cheaper price or something like that. Just be aware of any potential issues, because if you're not aware of it, it can hinder the loan process. Prepare all your documentation, have that all ready. Disclose any source of income or debt that might show up. The underwriters, when they're looking at this, they want to make sure that they know everything. If something pops up, it can delay or change the loan offer, which can then in turn hurt your offer that you have on the house. Things that can delay or hurt the process. Getting new debt. So when we were buying our home, my son, all of a sudden, he had to get $3,000 worth of dental work. So where am I coming from $3,000? And the dental place was like, oh, we have a 0%, for 2 years payment plan. But that would have been new debt, and it would have messed up our loan. So I had to figure out how to get $3,000 because it timed with when we were buying our house. Switching jobs. If you get a new job and you have already started the home buying process, you need to tell that new job, I cannot start until my home loan closes. Because when you switch jobs, it can be something that the lender sees as you're not stable and your job is not secure. So do not switch jobs when you started the home buying process. Do not go on vacation because there may be things that you need to sign. Now, luckily, we can do a lot more things electronically, but if there's paperwork you need or anything that you need to do, don't do that during the home buying process. Incomplete or incorrect documentation. Make sure everything is signed, that you have all of that stuff in place. Okay, so that's that. I can now open it up for questions. Yes.
Do you recommend having a realtor versus doing it on your own, or about that?
So a realtor will help you. Oh, yes. So the question was, would you recommend having a realtor or looking on your own? So realtors, they understand the home buying process. They can help get you, they know other realtors. Of course, there's fees, but oftentimes realtors, they want to work with other realtors. So usually, unless it's like a known entity that you're buying, I would say most people work with realtors. It's a lot harder to do without having a realtor. You can start the process, but actually going through the whole home buying process, usually you do need a realtor. Yes.
Do lenders look at all three credit bureaus, or what?
So they asked, the question was, do lenders look at all three credit bureaus? Yes, we'll look at all three credit scores. Yes.
Do you have a service or know of someone that does that work of going through the credit reports and helping clean that out? That's just overwhelming for me sometimes when I see stuff, but is there any place that you can recommend that?
So the question was, do we have any resources for people to help you if you do have credit repair and you want to go through your credit report and understand it? Yes, I can't remember the name offhand, but I will figure out and get you that information.
There's a couple resources that can help with credit report reviews. One of which would be that Ventura County.
Downtown My Way Home.
That's right, My Way Home, yes.
My Way, BCCD, like a lot of, yes.
And then there's a second organization, you can get in touch with them online, it's Balance Financial Fitness. You do it remotely, it's over the telephone, but if you Google just Balance Financial Fitness or Financial Education, it's an entity out of San Francisco, they would help you do that,
So Balance Financial Fitness and My Way Home are two resources for looking at credit.
My Way Home will be presenting at 12:30 today as well.
Yes. They have so many resources. I highly, highly recommend My Way Home. They also offer more in-depth home buyer classes that you can take. So they're a great nonprofit that serves both Ventura and Morgan County. Yes.
If all of your finances are in one account, will they look at both of your credit scores?
The question was, if your finances are all in joint accounts, will they look at both credit scores? Whoever is on the loan, they're going to look at a credit score. So anybody who's going to be on the loan, they're going to look at all the credit scores. Yes.
Yeah. So what questions are vital to asking for choosing a lender? What questions would you ask to them or any additional?
So what questions would you ask to a lender? So a lot of it for me, I would recommend is, okay, what are the different loan products that you offer? What are asking them what they think the benefits and like what are the pros and cons of the different loans? Because obviously, if you're going to get an ARM loan where it's an adjustable rate mortgage, there's some benefits, but there's also some cons because your mortgage is going to change over time. It has to do with how much is going towards principal versus interest versus a 30-year fix. And getting their sense of openness. For me, it's a lot about, okay, is this somebody who I feel comfortable working with? How much information are they sharing with me? Do they want to be educational? Do they want to be a partner in this process? So a lot of it is going to be that feeling that you have and how available they are. Do they have resources, a realtor, the partners that they would recommend working with? Because it helps you understand how well networked they are as well. Those are kind of some of the questions that I would ask. Yes.
I have a question. Back to the first part of your presentation, when you're talking about percentage of the down payment. Most common loans are 20%, or the FHA is 3.5%. What are these negatively amortized loans that they're offering that you can get in a home for $1,000, $2,000, $3,000 down, finance your home for 50 years, your grandchildren will be able to pay it off? What type of a structure are you putting, or liability are you putting on your personal investment?
So I don't know as much about those negative amortized. There's huge amounts of risk. I think because it has to do with you're paying a lot towards interest versus principal, and so how much you're going to own the home over time, right? And so how much. So any loan when you first start out, when you look at your payment, the share when you look at that payment, more of it is going towards interest than it's going towards principal, right? Because the lender, whether it's a car loan, anything, they're starting to collect their interest rate more, their interest money up front. versus your principal paying down, right? It's not like,
I completely understand that.
Yeah.
But what I'm trying to say is, in modern day world, it takes 2 people to work to buy a home, or 3 families are buying a 4-bedroom house, and they're trying to subdivide it and put up other inner structural walls to accommodate children and adults. So if you're buying a $1.6 million home and you're putting $4,000 or $5,000 down payment, you're carrying 95% of the value of that home in your house payment. So you'd be paying about $50,000 a year in your property taxes, your PMI, your interest, on top of the price of your loan.
Yes.
Now, do people realize how much they're jeopardizing their investment? Yeah, you can make an extra $500-600 a month. That goes straight to your basis, so you earn more value in the home. But what is the risk factor since you're the banker?
So a lot of the risk factors have to do with, one, property values, right? So we saw that in the, 07, 08 market issues, where people were in these loans, and then when property values started going down, people owed more than what they had, than that home was even worth, right? And so when then the market changed, when those market shifts happened, and then people's loans started maturing, and they had to refinance, they were not able to get a loan that would cover the cost of the home. So those, or they had to pay this big balloon payment, right? And so most of those loans were like outlawed from happening. So those are the biggest risks. Anything that sounds too good to be true, like those negative amortized loans. Again, unfortunately, our mortgage loan officer is sick today, so she would have been able to answer those technical questions more.
You see those
But-
types of loans being advertised again, get your loan out of the state, get your
Yeah.
money from this conglomerate with your money pocket. So
There's huge risks. There's
and I
huge
don't
risks. So
think
you want to be
people realize-
very careful, and that's part of what talking to your mortgage lender is to say, what does this mean when I'm going to, and so you understand, okay, when I get to that 10-year for what's going to happen? What do I have to come up with so that, I can understand what those. So that's part of having that conversation and working with a mortgage lender that is going to be open and upfront with you. I would say most of those amortize. I mean, there's a business there for a reason. They think they can make money on that, and
Yes, I was wondering, how is it even possible for the bank to loan or, one person or one income?
Well, yes. I mean, it depends, because it depends how much that person makes. Is that person buying a home on their own? Yeah, it's whoever is going to buy the house, but it depends like how much money they make, right?
Right, but what I'm saying is like, how often do you see that happen? Realistically, does it happen?
It does happen. It's harder and harder, particularly in Santa Barbara, to find a home because there's not very many homes that are on the market, period, that are affordable, right? For like 2 incomes. There are projects that do happen where they are affordable home purchases, so they're limited in how much they're allowed to sell the house for. And there's programs that we work with that are having builders build an affordable homeowner, not just rental. And so you're only allowed to sell a house for X amount of dollars. When you buy an affordable house, 1, you have to qualify income wise, and 2, when you sell, your home can only appreciate so much over time. It's not gonna appreciate at market rate because it has to stay on course. So those are things as well. You had your hand up. Did you still have a question? Yes.
If we miss the down payment workshop today, where can you find
You're gonna have it. So if the question was, where can you, if you can't stay for the 12:30, there is workshop and see the down payment system program. These will be posted online.
Yes, on our website, it's housingsantabarbara.org. The website's also in your resource guide in the back. There's a QR code in the.
HousingSantaBarbara.org. There's a QR code. Yes.
Are there any consider private homes that do not qualify for the down payment assistance or loan assistance?
Some of the manufactured homes, if you have to, for a lot of the down payment assistance programs, you must own both the land and the home, right? And so, if you're buying a manufactured home and you're just paying for the like coach, then the down payment assistance programs don't work. But if you own the land and the manufactured home, then it would count. Yes.
For VA loan, can you use those in conjunction with down payment assistance program?
Can you use a VA? Yes. The question was, can you use a VA loan or FHA loan in conjunction with the down payment assistance programs? And yes, you can. And there are, I believe, some also veteran assistance down payment programs as well. Yes.
So, do lenders, do they ever look at gray area or is it like black and white numbers? And do you ever have a conversation with them and say like, this is why something is happening and it'll fall off my credit in certain number of months or whatever?
So the question was, will lenders ever look at things not just black and white and just numbers only? Can you provide some narrative or some, kind of context that maybe they would make exceptions for things with maybe a different credit score, there's something negative on your credit report? And the answer is yes and no. It depends on the lender. There are certain lenders that are kind of like for numbers only. And then there's going to be ones that are going to work with you. My experience has been that the larger banks are a little bit more, like your Chase, your Wells Fargo, are a little bit more numbers only. And then some of your more smaller regional community banks or things like that will be a little bit more flexible. But again, it depends. But a lot of community banks, I know like Montecito Bank and Trust or other banks in the area are very relationship focused. So sometimes there's things that are kind of like, okay, well, we can do this here, do that there, and those types of things. Yes?
Is anyone here live in a mobile home park?
The question was, does anybody here live in a mobile home park?
No, but we have.
If you please get in touch with me. Oh, she's looking for a mobile home.
Okay. So there are different mobile home parks, and there's also a lot of banks do have, when it comes to manufactured or mobile homes, a lot of banks do have specific loan programs for those that are a little bit different. And so I know, for example, we do, but, and again, the down payment assistance programs, it depends on the down payment assistance program, but most require you to own both the land and the coach for you to be able to qualify for that. Yes.
For the banks in this area, how willing are they to work with if you find a land and want to actually build a house?
So the question was, how willing are banks to work with people to buy land if they want to construct? So it's all going to come down again to numbers. So you're going to look at, okay, are you taking a loan out just to buy the land? Are you taking a loan out for both the land and the construction? So it's going to be similar in process. But yeah, there's definitely banks that do that. Yes.
How early do you recommend starting with the home buying, contacting lenders, stuff like that process? If you have a specific property in mind to buy, or
So how early should you start talking to a lender, like in the home buying process? Do you already need to have a house in mind? I would say start earlier. They'll tell you how long, I don't know this offhand, but banks will tell you how long their pre-approval letters are good for. Because if you have that pre-approval letter, it helps you when you're going to look for a home. Because you've already been approved for a certain amount, up to this amount, or you can get your pre-qualified and then maybe change and you get your pre-approval. But those are, I would say, it's good just to start early, just to have the conversation, understand kind of what you need, and then kind of go from there.
The pre-approval letters that you would get from a lender are generally good for 90 days. And so if you want to gauge that as far as time frame, and if you need to renew that letter, the only thing you would typically need to do by then, because you've already supplied them with tax returns and W-2s and profit and loss statements. So if you need to renew it, you just need to give them updated bank statements and potentially pay stubs. So 90 days is how long.
So the pre-approval letters are usually 90 days, and if it goes beyond that 90 days, then you have to submit just kind of like the new pay stubs and bank statements and things like that. Yes.
Hi, I just didn't catch earlier when you said the credit score that mortgage, that lenders are usually.
Usually it's like 680 is oftentimes, but it depends on each lender. Ideally, you would like to be above 720 if you could, but some lenders will go below 680, but you start to have different kind of interest rate implications and things like that.
Better interest as your credit goes up.
As your credit goes up, you're gonna have that, and then the other thing, again, your PMI could impact things and all those. There's like lots of different factors.
I have a question.
Yes.
If you get approved in Santa Barbara County, can you go anywhere in the state of California and buy? Let's say you're looking at homes and the realtor says, I have a friend in real estate up in Tascadero or up in San Francisco, and I'm finding houses that are about 30 to 40% less price or market value what you're looking at and willing to relocate. Does it depend on the bank if they deal that far out?
So the question was, how far is your pre-approval letter good for? And it's going to depend on the bank and what they can geographical area. It's going to depend on the bank and also the terms in which they've done that letter. There's certain banks, like we're a regional bank, we only work in Santa Barbara and Ventura County. So we don't tend to lend outside of our footprint. And so it depends on the bank that you're working with. But so it depends. Again, it would depend on the bank. And if there's any terms, you need to understand that pre-approval letter and what it's good for. And because also then, is that going to require you moving? And is your job still going to be good? And that's going to have an impact on, the information that is.
People work out
Right, but let's say it all just depends on, there's different factors that can impact because, like
Berkshire and Hathaway are all over California, aren't they?
I don't know.
Yeah, they don't offer mortgages though.
Hey, what?
This is just a real estate agency. They don't offer mortgages.
They offer services.
Yeah, so local lenders is really who you're looking for. Yeah.
But they're not a lender. Berkshire and Hathaway. Yes.
So is Montecito Bank and Trust the best way to go?
I work on a Bank and Trust, obviously, but I've been, even as somebody who works at Montecito Bank and Trust, shop around. Look at what is best for you. I will always say find a loan, find what feels best for you. So like I'm gonna say yes, go to Montecito Bank and Trust, but there's different things, there's different types of loans. Like we don't offer VA loans. We're not a VA lender. So if you are looking so that's a veteran loan, don't come to us because we can't help you. Like I'm gonna say, go somewhere else. And so you want to find which loans, because different banks are gonna offer different things. So again, I would say everybody come to us, but I also, as a bank, would tell you to look around. That's the best thing to do and find where you feel comfortable. Yes.
My husband is incarcerated and his credit is low. He has student debt. I haven't put him on any of my bank accounts, and I do that now while he's incarcerated to help him build his credit.
I think so, but.
So can somebody piggyback off of somebody else's good credit in order to boost their credit score? And the answer is yes. You contact your credit card, for instance, and then you request to add somebody as an authorized user on your credit card. So it's not a co-signer and it's not a co-user, but they can piggyback off your credit. So in this case, yes, that'll be a good opportunity, but also for kids, for children. If you want to help the kids build their credit, by the time they get 18, you can add them as an authorized user to your consumer credit cards. Ideally, the ones that you've had that longer relationship with, so they can build their credit based upon your good.
But you want to make sure they're not just an authorized user. You want to make sure that it's recorded because you can have somebody who's authorized to use your card and it's not recording on them. It actually has to record on them. The other thing that you want to make sure is, so if you're doing things to help his credit, right, but there's still debt that he's being, you also want to simultaneously figure that part out. Again, yeah.
So can't you also, like, if you have a sick parent, and they'll say, I'm gonna add you to my bank account, and I'm gonna add you to my credit card, not paid upon death, but I'm gonna add you as an authorized signer, that is a way that they can get a bank usually if something happens. That person, that child is already on the account, that child can be added to. Some kids make mortgages on their homes at the age of 15, because they're working part-time, and they just say, this is how we're gonna protect our family. And it's becoming very common.
So, yes, but if you put somebody if you add somebody as a signer on your account, they have access to your account. So there is a risk that is associated when you add somebody. Also, having somebody in your bank account has nothing to do with your credit. You having a bank account does not build your credit. It does not do anything. You're gonna need it when we look at your credit, like when we're looking at your character and all of that. Bank accounts have nothing to do with credit. Credit is borrowing money. It's the act of borrowing money, whether it's a credit card, taking out a loan, it's borrowing money. And when it's your money in your bank account, your bank account has nothing to do with your credit score. So, yeah, because even when you go to open a bank account, we don't run your credit score. It has nothing to do with credit. We look through something called check systems to make sure that you don't owe another bank something, that you committed fraud on the bank account or something like that. But it's credit your bank account. So when you use your debit card, even though it has a Visa logo on there, it's not building you credit. You're not borrowing money. You're just spending your own money.
So what do banks do when they run a background check? Like minors, you can know the day your child is born, and a month later you get a social security number, and you go open up an account for that minor baby, and everyone gives you money and presents at your baby shower, and then the parent runs over and puts the money in the infant, the newborn infant, the bank account. How are people doing identity theft using the infant social security number and banking information?
So, the question was, how does identity theft happen when it's a baby or a child? Information gets out there, numbers get leaked, there's data breaches that happen, and information is the amount of information that is out there, things are getting compromised. And it's not have to do with the bank, it does not have to do with, there's not one answer in particular, it's just that information is out there and it's being used maliciously. And so, but your social security number, there's just information that it's being used, right? It gets leaked, and that's why putting things like a credit freeze is important.
So we're gonna do one more question, and then we do have to wrap up this workshop, and we have another one starting at 11:15. So we'll take one more question, and then we'll do some reminders, and we'll wrap up the next.
At what age do you recommend starting or adding your child so they can build their own credit?
So you can start. So what age do you recommend having your child build their own credit? 18. 18. That's when you can start.